Welcome everyone. My name is Charles Osborne from TXF. This session looks at alternative finance within APAC and asks with demand never greater, do the same issues still exist? And I think even if we ignored the events at the beginning of 2020, the last few months has been incredibly eventful. We've seen major banks withdrawing from the jurisdiction, as well as larger scale funds having well-documented struggles. However, the beginning of 2021 was actually very positive, with margins increasing across the board, commodities pricing predicted to rise, and new investors taking a very interested look at the space. But of course, things can change very quickly. You know, what is the story now, and what does the future hold? I'm delighted to be joined by Nicholas Smith, Director, Private Credit at the Alternative Credit Council. We've got Tom James, CEO and CIO at TradeFlow Capital Management, and Jolyon Elwood-Russell, partner at Simmons & Simmons Law Firm. First, actually, before we take a minute to introduce ourselves, I do also just want to introduce a project that we're all actually working on, which is we're doing a research report in non-bank lending within trade, receivables and commodity finance. All of us on the panel, which I think is great, is we're actually all involved in this. So everyone listening, once it comes about, if you could kindly work with us to take the survey, as well as, of course, to keep an eye out for when this report comes out, because I think it's going to be a very seminal piece of research. We're grateful for everyone that is supporting. But perhaps everyone can take a minute to introduce yourselves. Nick, if you could go first, please.
Thanks, Charles, and good to see everybody today. So I'm Nick Smith. I'm a director at the Alternative Credit Council. We are a trade body representing asset managers who are pursuing private credit strategies. Our members are global, operate multiple types of investment strategy within the private credit label, and my role focuses on our advocacy and research program. Thanks.
Great, thanks. Tom, if you want to go next.
I'm Tom James. I'm CEO and co-founder of TradeFlow Capital Management. We're based in Singapore, and we operate a non-credit, non-lending approach to enable physical commodity trade, in particular for SME size firms, and been operating there for 3 years. And yeah, very interesting market situation.
Thanks, Tom, and welcome. And last but certainly not least, Jolyon, please.
Well, thank you very much for having me. I am a finance lawyer that acts for both banks and non-banks here in Asia. I'm based in Hong Kong, and I specialize in trade and commodity finance. But generally that includes receivables and goes all across the board to project finance as well.
Great, thank you. Welcome everybody. So just diving straight in to some of the most topical points, really. And, you know, as I mentioned, we've seen banks, various banks leaving the jurisdiction. We've seen a lot of press about some of the large scale funds in the region and globally having some difficulty. Who is financing in APAC currently, and what opportunities are there for new investors, do you think? Nick, perhaps you could start us off by shedding a bit of light on that.
Sure. I think you know, the story in Asia is a very similar story to what we see in other regions, in other markets. You have banks retrenching to things that are seen as non-core for a mixture of regulatory reasons, and from a business point of view, you know, they're commoditizing their business and focusing on their key strengths rather than trying to do and be everything everywhere. And naturally, you know, the demand for that type of finance has not gone away. It still exists, and so asset managers are stepping into that gap and effectively acting as an alternative. Now, what you kind of you know, that's the sort of general story, but it plays out very differently depending on where you are in the world. So the US and Europe are a very different starting point from Asia, for example. One way to demonstrate that would be to think about the typical investor base. So both those regions have a strong home market for institutional investors, who tend to be the primary investors into non-bank lenders investing in the US and Europe. So pension funds, insurers, not necessarily sovereign wealth in that example, but that's where the bulk of the capital comes from. Whereas in Asia, our research and our members' experience finds that it tends to be kind of pension funds with family offices as the bigger investors, than a larger proportion coming from high net worth individuals. The reasons for that are, very simply are that the risk premium that people see in Asia, particularly on the institutional side, makes, raises the bar in terms of what people expect from a return side, particularly for the institutionals. Like why would I go to Asia when I can get something very similar in Europe, but what I would suggest, what they might see as a lower risk profile. So there's a challenge there. I think what I would add though is that we increasingly see our members either setting up new offices in the region, whether it's kind of moving staff and setting up a base organically, or even acquiring existing managers to sort of instantly get a bigger footprint. And then also we've got a strong locally based community who've been operating in this market for quite a long time. And the thing that is sort of increasingly drawing investor capital to the region is that people like private credit. They're attracted to the asset class. They like the diversification, the non-correlated income. The returns can be attractive compared to other fixed income instruments. But they're increasingly looking for something different. So while their gateway might have been, say, US mid-market lending or European senior secured financing arrangements, they've got a lot of that in their portfolio. And while they like private credit, they like what they can offer, they don't necessarily want more of the same. And so they're looking to Asia to offer them that diversifier in their portfolio. And then lastly, from me, you've obviously got a huge amount of wealth being created in the region, and a banking market that's not necessarily set up to finance that wealth creation, whether it's depth or breadth. And so people are, borrowers are needing new sources of capital. So there's a huge potentially untapped market at the moment. So I think that's broadly how we see things, Charles.
Thank you very much. I think thank you for your insights on that. Moving on to the investor side, to focus on that. What are the investors in the space saying right now, and do you think there's more education needed to that demographic? Tom, if you don't mind jumping in now.
Yeah, certainly. No, I think in fact it's a nice segue, because talking about fixed income alternatives and the way obviously the bond markets, the yields have been looking recently. We've been talking to investors, and many cannot buy equity shares in a hedge fund per se, but are much more comfortable with buying a fixed income product. So we've spent the last 1 year or so working on creating a fixed income product, a senior note program, which has just been made investment grade. So we can sort of bridge that gap, because definitely in terms of what investors are looking for, they're as we heard from Emma, they're looking for yield, but they're also looking for that RAROC. And so it's much easier for people to understand and interpret a note or bond which has a certain rating attached to it, than perhaps trying to understand what we do, which is that requires a bit more detailed examination when we're buying physical cargoes of different types of commodities around the world, and managing the physical operational risks around those to remove the credit risk element. I think that's where the way the bond market's been moving recently, that's where we're seeing perhaps quite a bit of interest from investors. They want the diversification benefits, the relatively low default risk of real trade finance in physical import exports of commodities, which ICC numbers show as sort of 0.05% traditionally, and they want that. They're searching for yield, because in Europe, a lot of these big sovereign bonds and other things are negative. It's a guaranteed loss, but a lot of people not so keen on that.
And I would add also, I think that private credit
Thank you very much.
private credit generally across, whatever strategy it is, whether it's real estate distress, is certainly drawing a lot of attraction in Asia, and obviously that is also then filtering through into wider, direct lending and trade and commodity strategies as well, and that's been a trend that's been happening for a number of years. So that's now. The features are very, very different, and there's no way, because you described that some of the banks are leaving in Asia, and there's no doubt about that. Now that sort of, but at the same time, private credit is not really there, and private debt isn't really not there just to fill the boots of banks that are leaving. It's because the features are so very different. In terms of what the investors look for and how the funds operate to banks, and that's something that needs it will be part of that education factor that you mentioned. You can't just place your boots in in Hong Kong and Singapore and think that you're going to pick up a load of good trade and commodity assets. You need to understand the region, the different jurisdictions, how you invest, how you get your money out. And as we always say in private credit, if you're a lender, then you're also an enforcer. And enforcing in Asia has always its own unique difficulties.
Yeah, I'd agree with that, Jolien. And Charlie, your question around is more education needed? We would say always. Investors, they like private credit. They like the ability to access assets that they couldn't access, say, 5 or 10 years ago. But they want to know what the nuances are around those. So if you're a lender, and you're in a particular market, what are the risk factors I need to consider? What experience does the firm have when it comes to restructuring or even enforcement, as Jolien mentioned? So I think there's that. And then there's particularly, like, what does good look like for the asset managers themselves? So how can I, what competency should I be looking for? What sort of operational setup? What sort of reporting are they preparing? And that tends to be one of the more challenging areas in Asia compared to say other markets where you have a more institutionalized reporting systems or expectations, let's say, that can be more challenging to meet in Asia, where data collection may be a little bit more patchy.
Thank you all for your additional input, and I fully agree. And I think the landscape is very different, and it takes a completely different approach. Just kind of going further and delving further into the side. What I've noticed, I've talked about this on many other panels actually, is what I've noticed in the last year is when putting mid-size or SME traders in touch with kind of the non-bank lending side, there seems to be this disparity in terms of pricing margin expectations because you've kind of got the mid-size of the SME player perhaps coming from a historic low margin from a bank that's perhaps retrenched and exited. And then on the other side, there's that expectation from the investors investing into the funds. But is there a pricing margin disparity problem in the area, in the industry, do you think? Jolien, if you could shed some light on that would be great.
Yeah, I will. If you look at private credit generally in Asia and take that as an example, as opposed to just and then come on to sort of the trade pricing, generally in private credit there is inevitably a big difference in margin expectations between what you would expect as an investor to what banks tend to charge. The rate of returns for funds tend to be somewhat higher than what the banks have traditionally offered inevitably. And so first of all, you've got that hurdle in terms of the investor expectations. You then add on that a layer of, well, it's Asia, therefore, because you're in Asia, I expect there should be some sort of Asian premium, because enforcing is difficult and I don't guarantee that I'm ever going to get my money back compared to what it would be in say in a developed market. And so then you add on another layer of that to say, well, actually, finding these, the origination is difficult in Asia, and therefore, how do we trust these borrowers, and will we get that back? So there is inevitably a big premium, and there's a massive disparity between what traditionally borrowers, traders have, as you say, with their relationship with their banks, compared to when they step in, when they have those talks with the non-bank lenders. But at the same time, the non-bank lenders would say, well, actually, no, what we're doing is developing is a longer term relationship, and the features of non-bank lending, it is not commoditized, it's more bespoke, and therefore a lot of the borrowers quite like the fact that, in terms of certainly on the direct lending strategy, they like the feature of that a fund is always behind them and it's always available there to make to grow with them and grow with their business. So yeah, it will be very difficult for just any fund to come in and say, yeah, we can offer the same as banks, because that model just wouldn't work. But at the same time, I guess also with the I've always been saying, the one advantage of COVID is perhaps that that has now changed borrowers and traders' expectations to say, actually, the price of borrowing for their model is not at what senior banks offer or trade banks offer, because that risk premium is probably higher than what base rates are. So if not, so that sort of expectation gap has, I suspect, been narrowed a little bit by COVID. And if they can't meet those expectations, then they might not get it from bank funding, so their model is they're going to have to rethink their model.
Thank you very much. Yeah, no, I think it's interesting, and I'm quite interested to see. And I think we're going to talk about this more in some of our events later in the year, because I'm interested to see how how risk is getting priced here, and particularly with with some of the expectations of some of the funds that I've heard of, and I think the fact as well is that it's not sustainable for a lot of these traders. It's not built into their model, and it's interesting to see the outcome of something like this, I think. Just conscious of time, and I moving slightly slightly to a different topic. Tom, if you could kind of talk us through a little bit about the collaborative finance approach, and how this potentially helps mitigate risk, and do you think this solution might increase in the next 12 to 18 months?
Well, no, absolutely. I mean, aside to the challenges around pricing, which we've heard discussed there, the other challenges are where banks are just pulling out of particular types of commodity transactions, maybe onshore certain warehousing or offshore storage, or even oil storage after various debacles here in Singapore with some storage facilities and bank losses, etc., like that. Because we've seen, unfortunately, since 2008, with changes in banking regulations, a lot of in-house commodity expertise lost at banks. So, I don't blame them that they're just not able to feel comfortable that they have the in-house expertise and knowledge to properly assess or certainly oversee certain types of transactions and feel that they have proper oversight and control if necessary. We've been, some of our SME customers in particular who are able to obtain some bank financing have actually brought us to their bankers, and since then we've been looking at this hybrid approach, where in fact we've sort of been labelled as sort of a neutral counterparty, or even collateral managers with skin in the game, in a way that as fund managers we buy and own the commodity, but also leveraging technology, IoT devices, camera systems, other types of security devices on physical infrastructure, plus also the fact that as a fund manager we're prepared to take first loss on a fund financing deal, and we have the oversight. It changes the risk profile of a transaction dramatically for banks. They know that someone is looking after the collateral, the physical commodity. They know that someone is there for sort of the first and second tier losses. So they're also then, again, coming back to the pricing situation, able to potentially lower their pricing expectations because the risk just looks so differently on their balance sheet.
Yeah, thanks very much, John. I think it's very interesting, and I hope as we continue to work together, we can sort of delve even deeper into this kind of collaborative hybrid financing.
I would add.
Yeah, go ahead.
Yeah, I would definitely add that Nick and I and the ACC did a report on private credit in Asia, and one of the clear findings of that from a number of interviews that we did was that the funds and the direct lenders and the non-bank the funds are not looking necessarily to compete and drive the banks out. They know they can't, and which is why I said that there was they know their limitations and they know their key strengths, and some of those strengths are coming in and working with those senior banks and working with those trade banks and working with others to provide extra tiers of debt or other slugs of debt at a different price. So and picking up on Tom's point, they love the fact of working with operators like Tom, because they don't have the operational back office, for example, as a traditional trade bank would. So this idea of collaborative, they just don't have the capacity for that. So, this idea of collaborative working is exactly the type of thing that they see as very attractive, I think.
Yeah, you've said most of what I was going to say, Jolie, and the only thing I'd add is that aside from some kind of minimum requirements, so like cost of capital and their own kind of risk appetite, when it comes to pricing, what we find is that non-bank lenders want to make deals happen. They will try and be as flexible as possible, and that's one of the key attractions for borrowers, that you're not dealing with a kind of a set menu of products. There is the opportunity to effectively structure more bespoke deals and find a way around things. And I think that's going to be extremely valuable over the next 12 months, as we're all sort of being buffeted by events and circumstances in ways that may be unpredictable. And so if we ask our members generally what sort of lending they expect to do in the next 12 months or so, they talk about having a bit of an open mind when it comes to opportunities that come that way. They may not necessarily just look at senior or just look at distressed. They're happy to move between everything in between, because they're the sorts of things that are going to happen, and you need a little bit of flexibility to adapt to that.
Yeah, I mean, the only thing I'd like to add there is that we're hoping. I mean, we just kicked off this senior notes program, which is almost at a third or fourth level of risk in terms of the sort of the waterfall in transactions, and that came up as BBB+. And we can structure the same sort of waterfall, the same sort of protection for banks in individual transactions. So, but now at least we actually have some sort of independent verification of how dramatically we can shift that that risk on the transaction, and hopefully make, allow the banks to lend into some of these deals more comfortably.
And we're seeing that on the demand for receivables as well. Notwithstanding current headline topics, there is still an awful lot of demand where there are senior banks involved, and there are then private credit funds that are looking at the I'd almost say a higher less ranked mezz piece for good receivable assets. We're just, there are a lot of deals out there that can still happen on that front.
If there is an increased cost to the borrower, and would said borrower be, are in your opinion, are these borrowers open to the idea of said increased cost?
If I may, I can just say that at least from the few transactions that we've worked with banks, it does become a blended rate. But then again, these are bigger deals. Our tranche is much smaller, although at a higher level. So net, they don't suffer such a big increase, perhaps, from what they'd been used to from the direct bank lending.
Okay, fantastic. Thank you all for your input on that last kind of topic. We're getting to the last couple of minutes, and so we're just going to work out if I don't believe we're going to have time for any other questions here. But just to let everybody know that there will be a live Q&A. That all but one, unfortunately, Nick is not able to join, but we're all the rest of us are able to make it. So for anyone listening, please do use this time to write in any questions that you have for the panel, and perhaps if we've got a bit of time, as we'll have a few minutes there, we might be able to get a couple of other questions around sort of digitalization and perhaps trade credit insurance. So it remains to say, just as the last thing, I just want to say thank you very much to Nick Smith, to Tom James, and to Jolyon Elwood Russell. Thank you all for joining me today.